Hello and welcome to the final Any Answers Answered of 2021. We will very shortly leave you to your tax returns, but as ever, Tim and I have picked a couple of questions from the pages of Any Answers to have a look at. And our first one this month, Tim, comes from Kevin McKay 14, who has a quick question about section 455, very hopefully titled Not Payable ? He's doing some due diligence for a client who is in talks to buy another business. The director's loan account is overdrawn, but an agreement is in place to pay this back over 10 years. Now, obviously, with the term being 10 years, the loan account is still overdrawn when 455 would be due. The accountant for the seller is saying that 455 is not due, as this loan is prescribed term, has interest to be charged. I think section 455 would still be due, says Kevin. So do I. What do you say, Tim?
Well, I agree with Kevin. It certainly should still be due. And first, we've got to take it as read, I think, that the director in question is a participator. Section 455, of course, applies on loans to participators. And if we're talking about the director selling his company, then I think that's a fairly given point. The comments that follow this question, the replies that are posted on Accounting Web, there are just 12 of them. And the first of them by Jeff56 makes the very good point, which is probably the cause of the confusion in the mind of the accountant that gave what I think we'll have to agree was duff advice. And Jeff's point is that paying interest of at least the official rate, which is what's happening here, will only prevent the benefit in kind charge. It doesn't get you out of the section 455 tax. And yeah, I've come across in lectures, as you have, Giles, I think, delegates who have mistakenly thought that if a director's loan is exempt the benefit in kind, remind me, Charles, what's the limit on the amount of a loan that can be exempt to benefit in kind?
So the benefit in kind rule is £10,000.
Oh, and there's a separate limit for section 455 of, I think, 15,000, but that only applies if you don't have a material interest, 5% interest in the company. So there's scope for confusion there. So yes, Tax Dragon says, was it a participator? Yes, I think we can take it that it was. And the point that is then made eventually by who makes it, I think it's Tax Dragon, is that the legislation is clear. It is only the point at which the loan is repaid or waived or written off that the section 455 liability is itself cancelled and that repayment could be made. And it is not going to be the sale of the company. And Tax Dragon is absolutely right. Kevin McKay, thanks Tax Dragon for the helpful tax advice, that being careful about the treatment both for P11D benefit in kind rules and separately for section 455 on these loans to participators continues to be important. And in this case, you may well have sold the company and have no further involvement in it whatsoever, except the new owners have agreed that you can repay your loan over an extended period, while the company won't recover the 455 tax in full until the loan is repaid in full.
The point I wondered about, and I'd be grateful if you could clarify it for us all, I wondered if because he ceases to be a participator quite soon after the start of this loan arrangement, does that then take us out of section 455? Because he's leaving as a director, he's stopping owning the company. Does that create a change of rules? But I suspect what you're going to say is that it's all about where you are on day one of the relationship rather than what happens next.
Yes, that's right. The loan was made when the director was a participator. That triggers the whole of the section 455 legislation, and it isn't reversed simply because he ceases to be a participator on the sale of the company.
Excellent. That's very, very clear indeed. Our second question comes from the brilliantly named Ian the Taxman, who, if you go on to the pages of Any Answers, do have a look at the little avatar that Ian has. It's a delightful avatar. Anyway, we will ignore that for now and go to his question. And he is talking about holdover relief claim, is what he says in the title. Number of years ago, we're talking section 165 holdover, he says, so nobody's died in this example. A number of years ago, the proceeds of a qualifying disposal rolled into the purchase of another qualifying asset and holdover was claimed. All seems good so far. It now appears that in the last few months, part of the asset has ceased to meet the qualifying conditions. Consideration was given at the time to non-qualifying elements and restrictions were dealt with. However, the question is, does this more recent change of use require a more recent change of holdover percentages?
The first thing I would say here, Giles, is that although the taxman refers to section 165, this has got to be a question about section 152. Section 165 would apply if it's a gift of a business asset, whereas here, I'm pretty sure we're looking at a disposal of a business asset rolled into the purchase of another qualifying asset, and we're looking at the rollover on replacement of business assets relief, which is section 152. And indeed, one of the answers to the question, there are only 5 at the time of recording, does make that point. The first one, in fact, by the dullard, not at all dull, makes the point, I think you're talking about section 152, and gives the answer. The answer is that once you have claimed rollover on replacement of business assets, assuming it's not a depreciating asset, where the rules are slightly different, but once you've made the rollover claim, then the base cost of the acquired asset, and it's a bit of a misnomer because the acquired asset doesn't have in any physical sense to have to replace the original asset. It must simply be one of the several classes of assets that are listed in section 152. The base cost of the replacement asset, so-called, is reduced by the amount of gain that is rolled over. And that base cost continues to be reduced up until the date of disposal of the replacement asset. So even though the replacement asset or part of it ceases to be used in the qualifying business, the rollover claim will continue to be valid. And so the answer, Ian, the taxman, is that the timing of the change of use itself makes no difference. The reduced base cost will continue to be effective up until actual disposal of the asset, and you needn't worry about the gain crystallizing until your client disposes of that replacement asset.
As I often say, Tim, the holdover relief rules are actually very specific and quite hard to wriggle around within, where the rollover relief provisions are actually quite generous. And this is a perfect example actually of where those rollover relief rules could be extremely beneficial to an awful lot of people. That's all for this month. As I say, the last episode of this year. Tim and I wish you a very Merry Christmas, a Happy New Year, and of course a very successful and straightforward January. And we will be back to talk to you on the other side. For today, bye-bye.